Welcome to the Banyan Edge Podcast. Here's your host, Charles Sizemore.
Welcome to the Banyan Edge Podcast, America's #1 source for smarter, safer, more profitable investing, where we bring you the very best ideas from the best minds in the business, completely filter-free. I am your host, Charles Sizemore. Joining me today is Mr. Adam Odell. Adam, it's good to have you on again.
Great to be here and great to see you again, Charles.
Yeah, indeed. Now, Adam, I know you're a big sector rotation guy. I've followed your work for years. I know that sector rotation is a big part of what you've always done. And what I've noticed this year is that we've really almost seen a reversal of the trends of last year. Last year, it was big cap tech blew up and kind of dragged the rest of the market down with it. This year, large cap tech is actually up big, kind of outpacing everything else. I want to say that the NASDAQ at last glance this morning was up about 16% year to date. S&P 500 was up about half that. But I also know that you like to be ahead. You don't really care what it's doing today. You want to know what it's going to do tomorrow. And I know from our talk offline that one of those opportunities you see is in small caps. So walk me through that. What makes you confident that this trend is likely to shift?
Sure. I basically see teeing up right now a once in a decade opportunity in small, high quality, cheaply priced stocks. But before, and I have research to back that up, but before we get into that, I just want to kind of mention at a high level what you just talked about was that in 2023 so far, it started off in January and the first half of February with basically what we called the junk stock rally. All of the stocks that had fallen 80, 90% through 2021 and 22 were rallying, beating the market. But it was all these stocks like, just the unprofitable tech companies, all the ones that came
the meme stocks,
SPAC stocks, all of the junk stocks, for lack of a four-letter word, that were just rallying like gangbusters in January and February, and leaving a lot of like conservative investors behind. And then what we saw kind of like on the tail end of that, once that kind of petered out a bit, is the return to the FANG, return to the mega cap technology, winner takes all companies, the Microsoft, NVIDIA, Apple, Google, Tesla, those names that really drove the bull market from 2017, 2018 into 2021. And we saw a resumption of the outperformance from those names. I think I did the math, and I think it was like about 5 stocks out of the NASDAQ 100 accounted for 75% of the returns. And it was like 18 stocks out of the 100 accounted for 100% of the returns. And again, it's all these big mega cap stocks. I think it's a head fake, not to spoil the ending, but I think it's a total head fake. I think that investors who wish they had made more during the tail end of the last bull market and maybe got left behind or got walloped in the bear market are trying to pile back into the same, 10 stocks that were doing well during those years. And I think they're going to be disappointed when the trend turns.
They missed the boat. They're just desperate to try to get back on that trend and kind of catch what they lost before. But the trend is likely changing.
Exactly. Yeah.
Now,
everybody, we're seeing a recession ahead. Everybody is forecasting a recession ahead. So whether it's a deep recession, if the Fed really fumbles, whether it's a shallow recession or an earnings recession, like in name only, it's still to be seen. And I'm not a forecaster, so I'm not, trying to weigh in on whether we will or will not get a recession. But my base case is to plan for the recession that is, more likely than not. My base case is also to plan for the possibility that the bear market goes lower and longer. I don't necessarily think we've seen the low. And that's good news and bad news. It's bad news for people who are holding, stock portfolios in the sense that we might have to weather some additional volatility for a while longer if the low isn't quite in yet. But I really see it as a buying opportunity because over the next, 3 to 9 months, if we do see lower lows in the market and we do see a recession, there is going to be a once in a decade buying opportunity, again, in these small, high quality, cheaply priced stocks that are going to be even cheaper. And I really think that I want to make sure everybody is aware of this opportunity so they can jump on it.
Now, beyond this window of time, I know that you generally like small cap stocks anyway. That's one of the 6 factors you track in your stock power rating system. And by the way, I will brag on that a little bit. I remember when you launched the system, right, kind of before the pandemic hit, I was one of your first users, actually. I've used it for years. I think it's a fantastic system, but the small size factor is a big part of your research there. Can you walk us through that?
Yeah, I mean, very broadly, the stock rating system, you can type in any ticker symbol, and my rating system will give you an overall composite score between 0 and 100. Higher scores are better. Anything that's 80 or above, we label strong bullish. And those stocks have been proven both in history and real time to beat the market by 3-1. But the 6 factors that we look for, we look for well-rounded companies and well-rounded stocks altogether. There are 3 technical or price-based factors. Those are momentum, size, and volatility. And then we look for 3 fundamental factors being value, quality, and growth. So overall, again, we're looking for solid companies that are high quality, that are growing faster than the economy, but that are also cheaply priced and priced fairly and have good momentum. The size factor is snuck in there, and the size factor doesn't always get a lot of notoriety as much as value or momentum or growth. But basically, the research shows for decades, this was one of the first factors that was discovered by Fama and French. And they basically realized that investing in stocks on the smaller cap end rather than on the large cap end, if you invest in smaller companies, you can earn a premium over time. Now, the premium isn't there every single year, but over the long arc of history, buying a portfolio of small cap stocks beats a portfolio of large cap stocks by several percentage points a year. So that's really.
I remember actually having to study that white paper in grad school. I remember Fama and French were 2 kind of pedigreed finance professors. Yeah, these were egghead professors that literally wrote the books, right? And they had always believed the market was efficient. Market's efficient. There's no value from doing stock research because all the information's already priced in. They very reluctantly admitted, yeah, we might have been wrong about that efficiency thing because we have this value factor. They called it the value, or they called it the value anomaly. They also referred to the size anomaly, which you would call the size factor. But I like that this was the factor that basically broke the academics, made them realize, yeah, maybe the market's not so efficient after all. Maybe there is a lot of value in looking for smaller companies that are kind of under the radar and whatnot. But Absolutely. Okay, so pivoting a little bit here. I loved your piece in the Banyan Edge last week. It was profiting from the hedge fund blacklist. I love that. Blacklist makes you think, forbidden fruit. This is something I'm not supposed to be doing, which always makes it seem all the more enticing. So walk us through that. What is this blacklist? Why is it that hedge funds are not able to buy certain stocks, but you and I can?
Well, that's the distinction. It's a blacklist, quote unquote, for hedge funds, pension funds, insurance companies, endowments, all of the very large, quote unquote, institutional investors that manage money for retirees and whatnot. And it's really, this class of stock is off limits to them. And it's not off limits to us, the regular individual retail investor. And that's really, I mean, if you think about it, Wall Street has so many advantages over the little guy. Typically, they have more money, they can hire PhDs, they can co-locate their execution software so they can get better and quicker fills on their orders. So the list of advantages that we have over Wall Street is pretty small. But I truly believe that this $5 stock anomaly is one of them. And basically, there's a ruling and there's regulation and law that goes back to the 1930s, and it was born out of the SEC. And basically, it allows regular investors to invest in any stocks, but large institutional investors have to jump through a ton of hoops if they want to buy a stock that's priced below $5 a share.
And I might just kind of cut in one thing. Remember, the SEC was launched in the early 30s as a result of the 1929 stock crash. And I have my own theories as to why certain rules got made. I think it kind of boils down to they were new at this. They didn't really know what they were doing. And so they just kind of threw laws up that looked good and may not have really made a lot of sense.
Exactly. And if you look at the history of laws, I mean, there are so many laws in the books that don't make any sense at all. Maybe even they never made sense, but they certainly don't make sense in today's era. And I think this is one of them. It just has never been revised, never been rewritten. And so many of the large institutions, they've passed down from one generation to the next their internal controls, their rules. A lot of these funds and institutional investors, they'll sell a stock as soon as it dips below $5, just because they know they don't want the hassle of dealing with all the extra regulation and headache and paperwork and oversight. So they basically don't want to touch any stock that's
it's
under
not
$5.
worth it. They have 10 other things to do that day, 1,000 other things to do that day, dealing with extra paperwork to hold that one stock,
Right.
which may only be 1% of their portfolio or less anyway. They're just not going to mess with it.
Exactly. And if you think about it, if you don't want to have to compete with Wall Street, you have to find an arena, a playing ground where Wall Street doesn't want to be or isn't allowed to be. And that's really why I think that we can take advantage of this $5 stock anomaly. Now, let me be clear. There are a lot of stocks that trade for under $5. My team and I crunched the numbers. It's almost 2,000 in total. And a lot of these are really tiny companies that barely trade and that you really wouldn't want to invest in them at all. And I would not recommend it. So I've actually, with my team, put together this blacklist list, and we've whittled it down to 300 stocks initially that are large enough to be rated by my stock rating system. Now, they're still small cap stocks mostly, but they can be rated. The other thing with this is that most of the analysts on Wall Street just don't cover these stocks. So, regular investors are kind of left on their own to dig through the paperwork and figure out if it's a good or bad stock. Frankly, there are a lot of stocks that are priced below $5 for a reason. They're not good quality companies, and they're cheap for a reason, basically. But
maybe they used to be a $50 stock and now they're $5.
Exactly. And that's not the type that we want to buy. We want to buy the high quality stocks that are small, too small for Wall Street to care about, that throughout this bear market have gotten, traded down to very cheap valuations. And the thing that we know is that once these stocks rise back above $5, they automatically appear back on Wall Street's watch list, and Wall Street's free to buy them. The institutions can jump right in, and that often creates a big flood of money back into the stock. It creates momentum. The momentum feeds on itself. So this is really a way to potentially, when you find the right stocks, make very high returns and beat the market over a short period of time.
Well, this is where it gets interesting, because I think to a lot of viewers, the concept of a low value stock may be kind of hard to distinguish from a low price stock. There's really two different things going on here, but they intersect. When you talk about a stock being cheap as a value stock, you're meaning relative to its earnings, relative to its sales, relative to its dividend, relative to some metric. A stock can be, priced at $1,000 a share and still be cheap because it's compared to its earnings, et cetera, it's priced cheaply. A low price stock is, actually, let me back up for a second. Then you also have smaller companies. A small cap stock is also not necessarily a small priced stock. It's just a stock that is valued at less than 2 billion. Generally, is the definition there. So you're talking about companies that tend to be smaller, kind of under the radar. Now, this price factor, this $5 price limitation, that's another layer here on top of these others. And interestingly, it kind of intersects with both, because if a stock is trading at less than $5 a share, oftentimes it's also a small cap trading for a couple $100 million or even less in total market cap. It may also be a value stock because it may have previously been worth more than $5, and for whatever reason, it's been pushed down. So I think this is interesting. This filter you're putting in, this $5 filter. For one, it does tend to kind of overlap with your value and your size factors, which is good. Those are 2 of your 6 factors that have been proven to work. When a stock potentially goes over $5 when we're buying it under, and then it starts to get over that threshold, that's when Wall Street can jump in. Then your momentum factor can also kick in. So this one $5 filter here essentially overlaps with 3 out of your 6 metrics in your stock rating system. I think that's really interesting.
Yeah, I'm looking for a convergence. I'm not looking for one factor. I'm not looking for one thing. I'm looking for a convergence of factors. You mentioned kind of 3 of them. The fourth one is quality. Again, a lot of small companies are high risk. A lot of companies that are priced below $5 a share are that cheap for a reason. And a lot of them aren't necessarily even cheap on valuation levels. So you have to find a high quality company that is trading cheaply on valuation, that is also below $5 a share, meaning the analysts and the big institutions are completely overlooking it, And then you're right. Once you buy that, and if you see a bit of a turnaround, then you can get the momentum to kick in above $5. But you're exactly right. I mean, the valuation. It's interesting in stocks. I mean, I don't remember the exact quote, but it's, stock market investing is one of the few areas when the price goes down, fewer people want to buy it. When the price goes up, more people want to buy it. But if you think about value, is really just thinking about it like if you're going to buy a house and you look at the price per square foot of the house and you use that. Maybe there's two houses on the exact same street, but they were built by the same builder around the same time, and they have different square footages. So you look at the price per square foot. Well, when you buy a stock, you basically are buying access to $1 worth of earnings. So the company is going to generate earnings, and for you to have access to $1 of those earnings, then you have to figure out, well, what price am I paying for access to $1 of earnings? Am I paying $5? And that'd be a P to E ratio of 5 to 1. Or am I paying a PE of $50? Am I paying $50 for that $1 of earnings? And so it's the same thing when you look to buying a house. I mean, if the houses are identical, but one is priced at $300 a square foot and one's priced at $150, obviously you want to buy the one that has the lower valuation. So that's what we're looking for. We're looking for value, quality, and size. And then really the $5 rule is just icing on the cake because it's a stupid rule. I mean, there's really no reason. We were talking about this before. There's really no reason it couldn't have been $6 or $10.
Why not 6? Why not 4? Why not $2.50? Exactly.
I mean, the SEC picked a random number and they didn't update the number for like 100 years almost. So really, I mean, this is our window to take advantage of that anomaly and to really get a leg up on Wall Street.
I like that. And by the way, I am plagiarizing your analogy there of price per square foot on a house. Whenever I try to explain value investing to others, it's hard to get past that. What's the difference between price and value? I'm going to plagiarize that analogy you gave. Just so you know. It may be in small print. All right.
Fair enough. You can cite me. You can cite me in small print. Fair enough.
Well, very good. Well, Adam, this is interesting. So, again, to kind of sum this up here, there's an anomaly. There is this $5 rule set by the SEC almost 100 years ago that limits institutional investors' ability to buy stocks priced under $5. That creates opportunities for the rest of us because we have no such restrictions. There's nothing to stop us from dabbling here. And that gives us a big one-up over Wall Street. We're able to go where they can't. That's a really nice advantage. It's one that, at least for the foreseeable future, should persist unless the SEC decides to update its rule book after 100 years, which I'm not holding my breath. So
if they haven't done it now, I doubt they're going to do it. So
probably not.
Yeah. And now's the right time, really, because as I mentioned earlier, we're heading probably into a recession. We are in a bear market. I've done the research. The smaller cap stocks outperform large caps basically by 2 to 1, even if you just buy at the index level, coming out of recessions and bear markets. They've done that for the last 9 out of 9 recessions. Small caps have beat the large cap stocks. And if you look at 2009, basically the 2008 great financial crisis, of all the factors that are built into my model, size, value, quality, growth, volatility, basically the size factor was the number one factor from 2009 to 2010, that 2-year period.
That was number one. That even trumps value and momentum and everything else. Wow.
Well, size was number 1 and value was number 2. So they kind of go hand in hand. Finding small companies that are cheaply priced coming out of recession, that is the way to trounce the market.
Yeah, it's interesting because that begs the question, why? Is it because these smaller companies are a bit more nimble? Are they closer to the ground? They kind of have their finger on the pulse of their market. Why do you think that is?
Yeah, on the risk side of it, smaller companies can be riskier, and it's a case by case basis. A lot of them don't have as diversified of a product line as a large company. They maybe don't have access to the same amount of capital at good rates as larger companies. The volatility of their earnings may be greater, the volatility of their cash flows. So that's really why just going out and buying any small cap company is not necessarily the way to go. You have to have some type of system to find the right small cap companies. But that's the risk-based explanation. The other explanation is just that, as you said, these smaller companies are more nimble. If there's a sea change in the economy and in the sectors that are doing well, small companies can adapt much more quickly than large companies. So that's really, you see a lot of companies, small and large, go out of business during a recession and a bear market. But the ones that survive, the smaller ones, are the nimble ones that know how to adapt and really take advantage of the new environment rather than get left behind. So that's really why we see the small caps do so well coming out of bear markets and recessions.
No, makes sense. So this is encouraging. It shows that even if we do have this continued bear market, even if we do have a recession, there should be some really nice opportunities coming out of it. You've already done the homework for our viewers here. You've compiled the list. These are stocks that rate well on your stock rating system anyway. We've added this extra filter for that $5 filter, and we've created a really, I'm taking credit. You have created this. You've created this really nice list here. Where can viewers find out more? Where can we send them?
Yeah, good point. We've probably spilled the beans, but basically I'm holding a special presentation on this $5 stock anomaly, and the presentation is April 27th at 1 p.m. But we're doing kind of welcoming people as a lead up to that event, and I'm going to be sending out a couple of videos as well as a couple of stock watch lists, this blacklist, in which we start with about 300 stocks. And then over the course of a week and a half or so, I'm going to be whittling down that list of stocks to under 40. And then during my presentation on April 27th, I'm going to be revealing the names and ticker symbols of my top stocks, a very small handful of stocks that are priced below $5 a share, that are trading cheaply, that are small companies, that are high quality. And that's all going to be revealed on April 27th at 1 p.m. But yeah, we need to include a link either in the email or this video, I'm not sure. But people can kind of join in on the journey as we head into that presentation and follow along with my watch list.
Very good. Very good. I will be there myself. This is an interesting concept. It's one I like. I'm always looking for that next thing coming out of a bear market, and this is it. So Adam, thanks for joining, and best of luck on this project. I don't think you'll need it though, because it looks like it's already working for you.
Mm-hmm. Thanks, I appreciate that, Charles, and good talking to you today.
All right, have a good one. Thanks again for tuning in to the Banyan Edge podcast, and I do recommend you give Adam's research a look. He's done an excellent job putting this together, and we will see you again next week on the Banyan Edge podcast.